Have you ever looked at a stock chart and just felt completely lost, like you're trying to decode some ancient secret language? Well, today, we're going to be your translator. We are breaking this down one simple piece at a time. Let's jump right in.
Yeah, I know. A screen packed with these little green and red bars can look super intimidating. But you know what? There's a secret here. Each one of these little shapes, it's telling you a story, and I promise by the end of this, you'll know exactly how to read them.
All right, first things first, let's look at the basic building block of any chart, the candlestick. The best way to think about each candle is like it's a snapshot of a battle between the buyers, who we call the bulls, and the sellers, the bears, all happening over a specific period of time.
Now, the colors make this pretty simple. Green means the price closed higher than where it started, so the bulls won that round. Red means the price closed lower than it opened. The bears took that one. And as you can see, every single candle gives you 4 key pieces of info: the open, the high, the low, and the close price.
So every candle has 2 main parts. You see that thick, colored part? That's the body. That tells you the story of the open and the close. And those thin little lines sticking out of the top and bottom, we call those wicks or shadows. They show you the full drama of the session, the absolute highest and lowest points the price hit during that battle.
Okay, listen up. If you only remember one thing from this entire explainer, please make it this. This is the single most important idea you need to understand what any of these patterns actually mean.
And here it is. Context is everything. A pattern by itself is totally meaningless. You have to know where it shows up. A bullish pattern, one that signals prices might go up, it only counts if you see it at the bottom of a downtrend. And a bearish pattern, signaling a drop, it only matters if it's at the top of an uptrend.
So with that golden rule in mind, let's dive into our first group of patterns. We call these the reversal patterns. Think of them like a warning flare shot up in the market, signaling that the trend we're in, well, it might be about to turn around. And boom, here is our golden rule in action. Just look at these 2 candles. They're identical, right? A little body at the top with a super long wick at the bottom. But one is a bullish hammer, and the other is a bearish hanging man. What's the only difference? Location. The hammer shows up at the bottom of a downtrend, hinting at a reversal up. The hanging man appears at the top of an uptrend, warning of a reversal down. Same shape, completely opposite meaning.
Now here's something that really trips up beginners, so pay close attention. For these reversal patterns, the color of the candle itself, it doesn't matter. A red hammer at the bottom is still a bullish signal. A green hanging man at the top is still a bearish one. It's the shape and its location that hold all the power.
And here are their upside-down cousins, the inverted hammer and the shooting star. And again, look, 2 identical shapes. A small body at the bottom with a long wick pointing up. And you guessed it, context is everything. The inverted hammer appears in a downtrend, and it's a bullish sign. The shooting star, it shows up at the top of an uptrend, and it's bearish. Same idea, different shape. Okay, so what happens when that big battle between the buyers and sellers ends in a draw? Well, that's when we get what we call indecision patterns. These signal a pause, a moment of real uncertainty in the market, which can often come right before a big move.
This little guy that looks kind of like a cross is called a doji. It happens when a stock opens and closes at almost the exact same price. It's basically the market shrugging its shoulders and saying, we have no idea which way this is going. It's a perfect stalemate, and it can be a huge clue that a turning point is near.
So let's quickly walk through the story this one candle is telling us. Okay, the market opens. The buyers get excited and push the price way up. Then the sellers come in and slam the price all the way down. But by the end of it all, neither side could win, and the price closes right back where it started. Total indecision. But not all dojis tell the same story. Check out the dragonfly doji on the left. Sellers tried to crush the price, but the buyers fought all the way back to the opening price. That's a powerful bullish story. Now look at the gravestone doji. It's the exact opposite. Buyers pushed way up, but the sellers took complete control by the close. That's a really bearish sign when you see it at the top of a trend.
And very similar to the doji, we have the spinning top. This also tells a story of a huge fight. Those long wicks show you both the bulls and bears made big moves, but that tiny little body tells us that, in the end, neither side won. And just like all our other patterns, what it means depends entirely on where you find it on the chart.
All right, let's flip from total indecision to absolute conviction. This is a marubozu. Basically, it's a candle with a full body and no wicks at all. A green one means the buyers were in 100% control from the moment the market opened to the moment it closed. A red one means pure seller domination. This is a pattern that just screams strength.
So, we've learned the alphabet of candlesticks. But knowing the letters isn't the same as reading a book, right? How do you actually use this stuff? Well, it is not enough to just spot a pattern. You have to wait for confirmation.
Acting on a potential signal is a really simple two-step process. First, you spot a valid pattern in the right location. Second, and this part is absolutely critical, you have to wait for the next candle to prove that you're right.
So, let's say it again. Step 1. Identify a valid pattern, like that hammer or a shooting star, at the absolute bottom of a downtrend or the very top of an uptrend. If it's just floating around in the middle of a choppy chart, it's probably just noise.
And step 2 is all about patience. You wait for that next candle to finish forming. For a bullish signal, you need that next candle to close above the high of your pattern candle. For a bearish one, you need it to close below the low. That confirmation, that's your real signal to pay attention.
Now, before you get all excited and jump onto a trading app, let's just ground ourselves for a second. Understanding these ideas is one thing, but applying them in real time, when your own money and your own emotions are on the line, that's a completely different ballgame.
So what's your first step? Easy. Paper trade. Just open up any free charting tool online and watch. Observe. Try to spot these patterns as they form in real time, all without risking a single penny. It is by far the best way to build real experience safely.
We've just given you the basic alphabet of the market's language. Each single candle is like a word, and when they come together, they tell these incredible stories of battles won and lost. So the only question left is, now that you know how to read, what stories will you discover?